So one of the questions that I get asked about, probably more than any other question on the channel, is whether I think that people should still be buying stocks at this time, given that there is so much fear and so many warning signs about a possible recession happening sometime soon. Well, I can't tell anybody what to do, but in today's video, I will be sharing my opinion on why I actually do think that a recession will be happening probably within the next couple of years, but I'll also explain the reasons why I'm still buying stocks regardless, and I'm also going to explain what I'm doing to prepare for the next stock market crash. And I'm going to try to do all of this in a very unbiased way and look at all sides of the argument, so it should be a lot of fun. Please consider hitting the like button if you do enjoy this video. It really helps support the channel and it means a lot to me. But with all that said, let's go ahead and get started. What's up everybody, my name is Ale and welcome to my world of stocks. Alright, let's go ahead and get started by looking at just a couple of the different warning signs that a lot of people are talking about right now that point to a recession happening possibly sometime soon. Well, for starters, there are many global issues going around right now. If the United Kingdom leaves the European Union without a withdrawal agreement, or what we would call a no-deal Brexit, then that could drop the UK and the European Union economies into a recession, which would obviously hurt other parts of the world as well, as European demand for exports would likely go down. I personally think that some sort of deal will be done, but it's a risk nonetheless. And the whole Brexit situation isn't exactly comforting when we already have other issues like Germany going through a slowdown that was actually very close to being considered a recession. If you go by the very broad definition of a recession of being 2 consecutive quarters of negative GDP growth, then Germany just barely missed it as they declined by 0.2% in the third quarter of last year and were just barely flat the quarter after, barely missing what we would consider a recession. Italy, on the other hand, did see 2 quarters of negative growth of 0.1%, which did trigger a recession that is mostly due to large public debt and high immigration of their skilled workforce. Speaking of which, other European countries are experiencing similar debt issues as well. Greece alone is scheduled to continue making debt payments to the European Union through 2060 for hundreds of billions of euros that have been loaned out. As if Europe wasn't a big enough issue on its own, there happens to also be a trade fight going on between the 2 biggest economies in the world, those obviously being the United States and China. If the trade dispute is prolonged for several months or even longer, the risk of a global recession would grow by a tremendous amount. As a result, we're already seeing the Business Confidence Index experiencing a pretty steep drop as corporations continue to worry about all of this macroeconomic uncertainty. There's even a survey from Duke University that has been conducted every single quarter for the past 91 straight quarters, where they survey 500 CFOs from around the world and they ask them when they think that the next recession will take place. And it looks like 48% of US CFOs believe that the US will be in recession by the end of this year, with 82% saying that it will have started by the end of 2020. Across the globe, 97% of African CFOs think that their countries will be in recession, while Canada sits at 86%, Europe at 67%, Asia at 54%, and Latin America at 42%. Not exactly a pretty picture to look at on a global scale. Adding more credence to global concerns, the managing director of the International Monetary Fund thinks that the global economy is very delicate at this time and notes that a 25% tariff increase could negatively affect US GDP by more than 0.5%. On the bright side, I do fully expect a deal to be done soon, and you can take this for whatever you like, but Trump did recently say that they are very close to making a deal and noted that it could be done within the next 4 weeks, but also added that it could be sooner or even later than that, so there's not really a whole lot of clarity on that issue. Still, I think a deal is inevitable given that both countries could really use the optimism, and a trade deal between the US and China would also help ease a lot of the global economic concerns. However, the issues do not stop abroad, as the US faces many challenges of its own. For one, debt levels are breaking new records every year, with the US national debt already climbing past $22 trillion, which is more than double what it was a decade ago, and on average, that makes up around $67,000 of debt per citizen and $180,000 per taxpayer. Keep in mind that we only bring in less than $3.4 trillion in federal taxes, but spend almost $4.3 trillion a year leaving our budget in a deficit of almost $1 trillion every year, with Medicare and Social Security alone costing around half of our budget. And those are two things that are very difficult to cut down on, as the baby boomer generation continues to give us around 10,000 newly eligible retirees every single day. That is a large amount of people retiring, coming out of the workforce, and needing Medicare and Social Security and things like that. And that's just looking at national debt. But when you include all types of debt, the US total debt sits at over $73 trillion, with almost $20 trillion in personal debt, $15.5 trillion in mortgage debt, $1.5 trillion in student loan debt, which, by the way, a lot of those college students are coming out of college with what I would really consider bogus degrees that are not going to make them a lot of money. So that's a really difficult situation as well. And then we also have over $1 trillion in credit card debt. And we all know that credit card debt is usually very high interest, it's variable rate. So that's not a good sign either. But this leaves almost $60,000 in personal debt per citizen. Pretty high amount. Now, US corporations aren't faring too well either, as their debt levels are said to have reached over $9 trillion back in November, which is an increase of 86% from the $4.9 trillion that we saw a decade ago. And when we look at the ratio of corporate debt to GDP, it's also at record levels of around 46%. This chart here only goes to around 2017, but you can see how almost every recession in the past followed a steep climb of corporate debt to GDP. And according to S&P Global, US corporate cash to debt was about a 1-to-3 ratio back in June of last year, but most of that cash was held by the biggest companies at the top. On the other hand, if we look at just speculative grade borrowers in 2017, that ratio worsens to a 1-to-8 ratio, or around 12% of debt. For comparison, the ratio was better even in 2008, where it was at about 14%, and we all know what happened then. To be fair, Fitch Ratings, which is one of the big three credit rating agencies, estimated in the second half of last year that new investment grade issuance was down 15%, while high yield issuance was down 32%. The corporate tax cuts have also been helping, as nominal tax rates have dropped from 35% to just 21%, and the top 100 corporate non-financial companies spent $72 billion of new cash flows to pay down their debt, while $81 billion went to share buybacks and dividends. So at least they are kind of paying down their debts. Fitch also noted that companies are now spending a much larger percentage of incremental dollars on debt reductions, and annual net borrowing data shows a big swing of companies changing from being a net borrower to now being a net payer of debt after the recent tax cuts. Still, it remains to be seen what solutions will be found, if any, to help the country deleverage out of what many are calling a very high debt bubble that will inevitably burst if we do not find a solution soon. Now, another warning sign that investors and analysts are looking at is the inverted yield curve, where the long-term bond, the 10-year US Treasury yield, actually fell below the 3-month, the short-term bond yield fell below it. And so that basically means that bond investors, the bond market, thinks that the US economy's future isn't looking as bright as we previously thought. And so many of these bond investors are trying to lock in higher rates now for the long term, because they expect the Fed will have to lower rates in the future to kind of help stimulate the economy, especially if we're in a recession. So that's kind of where the recession risk comes in. So if we're in a recession later, they're going to have to stimulate the economy, lower rates. So they're trying to lock in higher rates now for the long term, which is driving up the prices of long-term bonds like the 10-year. And when you have higher prices, that lowers the yield. So the long-term yields are actually dropping dramatically. Meanwhile, short-term yields like the 3-month was actually sitting above the 10-year. And this particular inversion hasn't happened since 2007, before we got the '08 recession. And it's also signaled many of the past recessions throughout history, including the past 7 recessions in a row. Still, it's not exactly unexpected to see this happen at this time, given that the Fed has been raising rates since 2015, which in turn has lifted short-term yields. And given that we've been in one of the longest expansions in history, it would obviously cause investors to worry about how much growth potential is still out there, which leads to less optimism for the future and causes long-term yields to drop dramatically lower, therefore causing an inversion. Add to that the recent Fed meeting in March, where they were more dovish than hawkish due to an expected slowdown of the economy, and you've essentially got a perfect storm to invert the yield curve. Still, slower growth does not mean negative growth, and even though the yield curve did invert, it did so just barely and very briefly. Keep in mind that most economic models that try to signal a recession with an inverted yield curve require that the inversion last at least a full quarter, but this latest inversion only lasted a couple of days, not a couple of days, but it only lasted about a week, as it inverted on March 22nd before returning to a positive percentage about a week later. But even if this signal is to be trusted, the time frame between the signal and an actual recession has varied throughout history, from going from just about half a year to as much as 2 years, and there's no reason why we couldn't see this go even longer than that, given that our economy doesn't really look as horrendous as people are trying to make it out to be. GDP growth has been climbing for a couple years now and reached as much as 3% last year. And not that you should trust the Fed, but during their last meeting in March, they did release their updated projections for the US economy, and they still called for growth of over 2% this year and just slightly under 2% in 2020 and 2021, with unemployment staying very low at 3.7% this year, 3.8% next year, and 3.9% in 2021. To be fair, we've often seen recessions follow soon after some of our lowest unemployment rates, so it may not be the most comforting statistic to look at, but it remains a positive one nonetheless as the economy continues to grow. In any case, I do think that there are a lot of warning signs that should be taken very seriously that point to a recession happening sometime soon, and that's why I'm still leaning for it to happen within the next couple years. But the reality is that we have really no idea when exactly that'll be, and it's still very possible that we could go the next 5 years without even seeing a recession, and even longer than that. It's possible. I don't think it's very likely, but it is possible. If we look back at the past decade, I could probably pull up articles for every single year in the past decade where people were predicting a recession either that year or the following year, and yet here we are in 2019 and we have no evidence of any of those predictions from fortune tellers ever becoming true. Just at the end of last year, so literally just months ago, people were so convinced that we were going to have a recession, the market tanked, we almost had a stock market crash, but we had a very big correction at the end of last year, and people were refusing to buy stocks and they were selling out of everything. And I'm being honest here, I was receiving comments and messages all over the place because I was making videos saying that I was buying stocks and taking advantage of that correction because I saw great companies trading at great prices. Like some companies were trading for as much as 50% lower, and these were really good companies. So I was buying up stocks left and right, and I was making videos about it, and I was getting bombarded with comments and messages from people saying that I'm an idiot for buying stocks because this was going to turn into the big crash that we've all been waiting for, and they were 110% sure that we were going to have a recession going into 2019. Well, here we are in 2019, progressing through the year, and there is still time left in 2019, but what I'm starting to see now is more and more people are now shifting their predictions of the next recession over to 2020. And I can guarantee you, if we go into 2020 and we do not have a recession, they're going to push their predictions over to 2021. And if it doesn't happen, then they'll push it to 2022, and it'll just keep getting pushed because that's really the pattern that everybody follows when they try to predict a recession. Now, before I end the video, I just want to quickly address that question of buying stocks now or waiting for the next recession or market crash. Essentially what a lot of people would consider to be timing the market. But in my opinion, it really depends on what your definition is of timing the market. If you're looking to sell at the very top and buy at the very bottom, then I completely disagree with your strategy. I think that's a very impossible thing to do. And I think you're being delusional if you think you can accurately do that. Because what ends up happening is the market will take a decent hit to kind of get the conversation started. Is this a correction, or is this turning into a huge crash that we've all been waiting for? And sometimes it's just a correction, but what ends up happening is you take a hit in the market, people sell out because they think it's going to turn into a crash. So they sell at a lower price, what is usually what I would consider to be a bad price, and is usually prices that I'm actually buying stocks because I'm trying to take advantage of it. But sometimes it's just a correction, and then the market starts recovering and they see everybody, they're on the sidelines and they see everybody taking advantage of the rally and they don't want to be left out. So they buy back in, and essentially they make very little to no profit, or they actually lose money depending on how they played the situation. On the other hand, if it turns into a market crash, then they feel like a genius at first, but they get so greedy, they continue to think that they're a genius, and they keep thinking that prices are going to get lower and lower and lower. Keep in mind that there's so much negativity at this time. Like if you weren't courageous enough to buy during a correction, it's hard for me to believe that you're going to have the guts to buy during a recession when companies are going out of business left and right. The economy's in the toilet. There's nothing but doom and gloom out there. Media, news outlets, they're all saying the worst kind of things out there. And even if the economy recovers, people will start saying that it's going to be a double dip recession. Any kind of recovery, people are going to say it's a fake recovery. It's going to come right back down. So a lot of people end up never buying, never taking advantage of those lower prices because they keep trying to get better and better prices. They keep being more and more greedy. And then the market ends up recovering and they end up following the same pattern that they did in the past, even if it was a correction where they essentially sold out. The market went down, it started to recover. They see people taking advantage of the rallies. They don't want to be left out, so they buy back in and they make very little to no profit, or they might even lose money depending on how they played the situation. Now, on the other hand, the only way that I could possibly see the point of view of somebody who wants to wait for a recession or market crash, because I don't think it's a outrageous thing to do. I don't think it's a super, incredibly crazy thing to do. I think a lot of people try to do it. They just don't do it correctly. But if you were to tell me that you were going to essentially average your way down, all the way down, and then take advantage of the start of the rally as well, and just buy everything in between, then I could kind of see that point of view, because at that point, you're not necessarily trying to time everything. You're just taking advantage of everything that's going on when the market starts to drop. Keep in mind, though, that could end up being just a correction, and so you'd also be buying during corrections as well, which I think is a good thing. But I could kind of see that point of view at least a little bit more than just trying to sell at the very top and find the very bottom. Now, if you ask me for what I'm doing, what my personal strategy is, I am more of a long-term investor. I'm more of a dividend growth investor. So I usually have very long-term horizons. I usually try to think decades out if possible, but I also take advantage of what the market gives me in the short term as well. Sometimes I'm buying stocks and they climb up a huge amount, valuations get ridiculous, and so I'll start to trim my positions a little bit and lock in some profits, but then I'll use those profits to buy back maybe the same stock at a lower price, or other stocks that I think are at great valuations. So I'm constantly reinvesting and making bigger and bigger positions for the long term. Also, there are many times where I just don't sell anything, like some of my biggest stocks, Disney, Microsoft, Amazon. Those are stocks that I don't really ever plan on selling, and especially if they're good dividend stocks, then I almost never really sell my dividend stocks, because those are stocks that I just want to hold for the rest of my life until I retire, and I just want to keep collecting bigger and bigger dividends, and that's kind of the whole point of dividend growth investing. I also try to follow a little bit of a Warren Buffett style, but maybe not in the sense that you might be thinking. Now, people have different opinions on Warren Buffett, because on one hand, people would say that Warren Buffett does not try to time the market. He's kind of just always a buyer of stocks, and he just holds them forever, never really sells, collects huge dividends. The power of dividend growth investing, by the way. But just kind of holds stocks, continues buying, doesn't worry about the next recession or crash, and he's always just kind of bullish on the US economy and the stock market. But other people would argue that he actually does try to time the market, because he's sitting on a huge pile of cash. I think it's like $112 billion now of cash for Berkshire Hathaway. So all the meanwhile, Warren Buffett is still investing in good companies at good prices when he sees them. When he sees a good opportunity, he takes advantage of it. But when there's not a good opportunity, he's just building up a huge cash position. So what do you think will happen during the next market crash? Warren Buffett will be in a perfect situation to take advantage of amazing prices. So he benefits from either scenario. If we do not have a recession or market crash for the next 5 years, Warren Buffett will still be making huge profits because he has great companies and great dividends, and he's making all this money. And alternatively, if we do have a market crash, he is sitting on a huge pile of cash to take advantage of all those great prices. So what I'm doing is I'm kind of doing the same thing. I'm always buying stocks when they're at good prices. By the way, right now, I don't really see many stocks trading at really attractive prices. There's a couple, but for the most part, I think the market is kind of really expensive right now. But an example would be at the end of last year during that huge correction, I was able to pick up some great stocks at some great prices. I picked up AT&T. I got it for less than $30, dividend yield of over 7% on my position. I think their forward PE was like 6 or something ridiculously low. Now, AT&T definitely does have their issues. They have a lot of debt, which doesn't really match well with some of the things that we talked about previously in this video. But they have some other growth prospects as well. And the thing about AT&T is that I got a great valuation, I got a great price, and a great dividend as well. And AT&T has been paying dividends for 34 straight years, even through recessions. So sometimes you can get some really good dividend-paying stocks that will pay you money even during recessions, and even during non-recessions as well, where people are kind of just waiting on the sidelines, losing their money to inflation. All the meanwhile, you're making profits when you pick up stocks during corrections. You make huge rallies. You're picking up dividend stocks as well. So there's a lot of money to be made in the market still. But when I don't see a lot of opportunities out there, I'm constantly funneling money into a cash position. And so I'm looking to exit 2019 with my portfolio being about 40% cash, so that I'm ready to take advantage of the next market crash. And if we go into 2020 and no recession there either, I'll probably increase my cash position even more. And I'm not doing that by selling out of all of my positions, kind of panic selling out of everything. Instead, I have a monthly budget that goes towards my stocks. And if I don't see a lot of opportunities, I just funnel a lot of it into my cash position to keep building that up. So when we get the next market crash, I will absolutely be able to take advantage of it and get some great stocks at some great prices. But if we do not have a recession, if we don't have a recession for the next 5 years, I'm still in a great position because I have great stocks and I have great dividend stocks as well. And that's just kind of how I feel about it. But I think that's about it for this video. I hope I'm not leaving anything out, but if you have any questions or want me to clarify anything, because I'm trying to fit a lot of information into a single kind of short video, so I apologize if I left things out or I wasn't clear about something. Anyway, I'd love to hear your thoughts down below. Leave your comments, and if you did enjoy the video, please consider hitting the like button, and I will catch you guys in the next one. If you want me to clarify anything, leave me a comment down below. It's hard to explain everything in this video, but thank you for watching. I'll see you guys next time. Take care. Bye-bye.